So hi everybody, welcome to today's session. My name is Lynne Wesonga. I'm a board member with the Alliance for Rural Electrification, which is an industry association I would like to think everybody's familiar with, because then, how else are you here? I'm also an associate director with the CrossBoundary Access team, and CrossBoundary Access is one of the largest project financing investors across sub-Saharan Africa. So we deploy capital into the mini-grid space as well as other energy access solutions, and to date we've committed capital up to around $80 million within Nigeria specifically. So today with me, I have a couple of investors, and I also have a couple of private players that will be talking to you about how the sector sees addressing the mini-grid financing gap. And I look forward to also at some point hearing your comments and just engaging with you. Please feel free to ask them very tough questions. I know for a fact Quentin over there has a whole cheat sheet prepared just to address any concerns you may have. All right, so maybe we start with Ward.
Yep. Hi, everybody. Good to be here. My name is Ward Nusselder, working as a Senior Investment Officer for FMO. FMO is the Dutch Development Finance Institution with a balance sheet of around 10 billion euros spread across the energy sector, financial institution sector, and the agri sector. We also have a pretty sizable portfolio in energy access, which for us is, we consider solar home systems, mini-grid, C&I, and clean cooking. And over the last, I think, 7 or 8 years or so, we've done around 40 investments in that space, totaling a bit over 300 million. In terms of mini-grids, not so much. We've done about 5 or 6 investments, I believe. And I guess we'll get into the reasons of why we haven't done more in mini-grids during this panel. So that's the cliffhanger of my introduction.
Hi guys, my name is Wale Lawani, Director of WeLight, Nigeria. WeLight is a relatively young company, 6 years old, but in that time we've built 150 mini-grids across Africa, mainly in Madagascar and Mali. We've worked closely with DFIs like ElectriFI. We've raising over 20 million euros from DFIs to deploy into this space. We are B Corp certified, so we take our environmental and social responsibilities very seriously. And yeah, we're hoping to be able to work with the DFIs, other stakeholders to really scale up our business.
Good afternoon. We have the difficulty to entertain you after lunch. I'm Quentin Antoine. I'm Senior Investment Officer at EDFI Management Company. And I work within the ElectriFI team in particular. So EDFI Management Company is the asset manager of the 15 European DFIs, including obviously FMO. So I have to be nice and towards my panelists here. We have a bit over $1 billion of assets under management today. I won't elaborate too much about what we do in terms of asset management, but we have been managing since 2016 the electrification financing initiative. It's a 300 million plus impact first facility that we're deploying, investing in many of the African countries in many of the business model, including mini-grids. We've been using many type of financial products from straight equity to senior secured debt. And we are very enthusiastic about the sector, but indeed there is many hurdles, and I think many of those already have been addressed in previous sessions. Hopefully we will not repeat too much, but obviously when it comes to financial structuring and financing of mini-grids, I think we will repeat obviously what some of the points that have been discussed already this morning. I'll stop here.
All right. Thank you. Thank you to all of you. So maybe the first question, just jumping right into it, we start with Wale. And with Wale, to kick us off, I wanted to understand from your private sector view, how do you perceive the role of DFIs in de-risking the mini-grid sector and attracting private investments?
Well, obviously they have a big role to play in doing that, right? So you have the conversation that started this morning about blended finance, about appropriate finance, about finance that is at the right price, in the right currency, with the right tenure. with, say, moratoriums and all of that. Okay, so that's on one side. But I think there is, if you're talking about de-risking more from a more global perspective, there's a role to play, say, in enabling infrastructure in the space. So GIZ, for example, has invested quite a lot in Nigeria in the data collection side of things with the SE for All project, right? So that has enriched the data available on mini grids. That is one example of an intervention that has helped to clarify a lot of data around the sector, which actually does help in de-risking. A key part of risk has to do with tariffs and has to do with currency, right? Tariffs are partly a regulatory issue. They have a role, so DFIs have a role to play because of their own reach and governmental connections. They have a role to play in helping us lobby regulators directly and indirectly. And they can do that also in partnership with entities like the REAN, with ARE, and so on and so forth, right? So I think that's also a very important thing to bear in mind. And finally, I think given the fact that they cover so much ground and they do so many investments, there's a role to play in knowledge sharing in terms of best practices to the extent that those can be shared openly. I think there's a big role to play in that also, which contributes to knowledge and de-risking.
Yeah, so it sounds like basically everything is solved and we do not require FMO or EDFI anymore. But now from, like, let's say Quentin's perspective, how do you feel like things have morphed over time from a financial instruments perspective to cater to some of the risks that are being identified?
Yes. Well. Yeah, difficult question, huh? The risk identified. I think, we can start with a broad risk assessment, and we all know the difficulties of investing lies with the predictability of cash flows. And I think this is what, from traditional investors and, DFI in particular, we like to be comfortable and understand, what are the cash inflows that will be coming and when exactly. I think when you look at infra investments, purely traditional infra investment, it's quite easy. You usually have those contracts, they're well designed, they're usually backed by guarantees. And so from that perspective, a banker or an investor is usually comfortable, right? Looking at the asset class of mini grids, you have scattered assets, mostly rural, unpredictability of revenue, and also the difficulties sometimes of getting them operating, of guaranteeing an uptime on the asset itself. So that necessarily requires some flexibility and some adjustment in the way DFI would structure. From our perspective, we have been using many types of instruments. So we've invested in equity, for example, to bridge the financing gap, the construction gap, with the aim to obviously being exited after construction of a group of mini grid, for example. We've also been involved when, in the case of WeLight, we support the growth, providing a loan with a certain clear milestones being set and linked towards that. Obviously, all products are available, but when we see the market, there is still this viability gap that remains essential. And I don't think the financial structuring from DFI we solve for that. I think there is a clear need to add different layers of financial products just to cope for the difficulties of managing the diverse risk of the asset class.
Okay, so it sounds like even the challenges identified cannot be solved through complexity of financial instruments. What maybe you can take us through how FMO has then since tried to, address some of these concerns as well.
Yeah, sure. So I think for FMO, the key requirement to make projects work really is scale. I think that's also been discussed this morning quite a lot. Because as a DFI, we can start funding from maybe 7.5 million upwards. And I think the key issue that we've seen so far is that most mini grids platforms or tenders are pretty small, right? Sometimes we get approached for, let's say, 10 mini-grids in northern Mozambique, or 10 mini-grids in rural Sierra Leone, or 10 somewhere else. And as most of you will know, to build 10 mini-grids, it is not super costly. Let's say it costs you $1 million, $2 million, depending a bit on the project. And if you have a 2 million type program, then often if it's rural, 50% of it is grants, right? So that's 1 million. And then of that 1 million, maybe 50% can be debt. So that gives me $500,000 tickets to finance, which is like 10 times smaller than what we need as FMO to make it work. And I still think there's a tendency from mainly donors, but I guess to some extent maybe also governments, to really focus on these micro interventions, which I think in the end will never allow the whole sector to really scale, just because of the requirements of funders like FMO, but also an African Development Bank or other DFIs. So I think what we really would like to see is more programs like the one in Nigeria, where you have really large-scale tenders, where it's really possible for mini-grid developers to get to scale and get there pretty quickly, rather than just a one-off tender of 10 mini-grids. Now, what we as FMO have done to get to this scale is by trying to pool as many assets as possible. So, for example, we financed one mini-grid player who had won tenders in Sierra Leone and in Uganda. They were not very related. Obviously, they're on other sides of the continent. The structure was different, but still, we tried to pool these assets together and work on a sort of a project finance approach to get to the size that we needed. Still wasn't really there in terms of size. In the end, we disbursed, I think, 2.5 million or so. So it's way below what we would normally do. But we're trying as much as possible to aggregate and make the sector work like that. Now, of course, the second thing we need is profitability, or at least some outlook of profitability during the life of the loan. I think we are very flexible in trying to stretch out our lending products as much as we can by providing tenors of 10 years, 11 years, sometimes even 12 years to the space, which is really what people or mini-grid developers require. But in the end, if there's not enough grants, or if the population is not, I guess, rich enough to afford the electricity, there's not much else we can do. Just like Quentin mentioned, financial structuring cannot solve the issue that some parts of the population just cannot be reached on a fully commercial basis. So I think for me, the starting point really is to have appropriately designed grant products. And once that's there, I think the rest will follow.
Okay, so that's interesting. And maybe this to Wale, if there's an appropriate grant program, and I think Nigeria was provided as an example of an ideal model for that, then can we consider all issues solved for developers and you are able to achieve scale? I don't know, we'll be looking at more than 100 megawatt very soon.
I don't know about all issues solved, but definitely grants, but definitely grants go a long way. There's a place for grants, which just as Ward said, there are parts of the population that cannot pay a commercial tariff, and that is a fact. So you are either going to ignore those parts of the population or you're going to have a grant program. And I think that there's a space for grant programs to also, there are different ways you can do grants. And I think one way, which I think I'm not sure is yet being explored as much yet, is consumption-focused grants, right? So why not have a commercial tariff, but then you're actually supporting the buyers, the end users. So there are different ways we could look at grants. For us in WeLight, we've definitely worked with grants. We've received grants. Those have been helpful, but we understand that to scale, you need to have a model that is inherently commercial and inherently profitable. And that's really what we build for. So we can't build a business around grants. We are open to grants, but we build a business around commercial tariffs.
Okay, so maybe stepping away from the conversation around grant as well, I just want to assess how and this is maybe for Ward and Quentin, how do you assess and manage the FX? Because there's been a lot of conversation around, and I think Wale also brought up consumption-focused grants and all of that. And there's a lot of people in the room who that would resonate with. But what about FX? So we have all the grant money. The Nigerian Naira is as volatile as it is. What happens in that case?
Yeah, so as FMO, at least, we can provide local currency lending. So that's not necessarily the issue. I think the case of Nigeria is a bit particular because we've seen that the official exchange rate has diverged so much from the black market rate, right? Which means that our normal local currency products don't really work. Because we are a bank based in Holland, we need to be repaid US dollar or euro in the end. It's okay if we get repaid less US dollar or euro if the local currency depreciated, but the physical money that we need to receive needs to be US dollar or euro, and that needs to leave the country somehow, right, to get to us in Holland. And historically, it's been difficult for us, for most of our projects in Nigeria, to get US dollar out of the country. So in the case of Nigeria and maybe Malawi, this doesn't really work. But in pretty much all other countries, our local currency offering does quite well. And then, yes, our interest rate is a lot higher than it is if it's in US dollar terms. But then at least you can price that into the tariff. And then as a developer, you're not just betting on local currency movements, but you can actually focus on running your business model. So, yeah.
Do you want to add to that?
Yeah, with pleasure. Look, the question is quite difficult, particularly for Nigeria, right? So at ElectriFI, we have taken the stand that, well, in the early days, we were open actually to take the FX risk ourselves. So decided to go hard currency and just embedded the FX would be embedded in our structure, in our position, and that was allowed and possible also because of the nature of the capital that we are implementing. Funding from the European Union, right? To which we don't necessarily have a cost of capital and a hurdle obligation, which gave us back in the days the capacity basically to take more risk than possibly a more structured and supervised bank, just like our licensed bank like FMO. Obviously, the current position in Nigeria makes it extremely complex. I think we're no longer have appetite to see our position basically melting like ice in the desert. This being said, we've tested a couple of things. We've tested back-to-backs with local bank here. We've been looking at partnering also with local banks and see what position is possible. We also can still do hedging position, so local currency financing and our positioning being hedged. That has obviously, given the current situation, either it's no longer available or it's just, unpayable. So what I see now in Nigeria is a lot of local currency financing options available. A lot. There is options available. Infra credits, UBA, Sterling, BOI are available in the market and looking for deals. Obviously, that has a cost still. I'm not sure that many of the project developers and the smaller in particular are capable to cope with the cost of that. The interest rate, is that interest, fit for, the top line nature and the revenue profile of the asset class again. So from our perspective, we're currently looking at Nigeria. We have investment capacity for Nigeria. We're looking for transaction, but the current macroeconomics makes it so hard for us to take an investment decision as it stands today. So it's very frustrating for me because I would love to deliver more towards Nigeria. It's very frustrating for our colleagues at the EU delegations from Abuja. Godfrey is here in front of us. He wants us obviously to deliver much more than we're currently delivering in Nigeria. So I think we would need to think a little bit out of the box and see whether and when exactly we're open to take more positions. But as it stands, I would just run away. No, I'm just a joker, sorry.
Okay, so Wale, maybe still along the same lines, what I'm hearing is, as a developer, and I think Quentin touched on this, maybe if you're also positioned as a small developer delivering 5 to 7 million or even lower, because what's looking at me like, no, lower. You're supposed to raise equity, you're supposed to think about local currency structuring, you're also supposed to deliver mini grids at scale. What are some of the things you're hearing from this that might actually prove to be a hindrance as a developer, and what's the support that can be provided by some of the DFIs and the public money?
No, I think Quentin and Ward have said are promising in the sense that I think the DFIs recognize the need for local currency financing. They recognize the need for financing that is appropriate to the business, lower IRR, et cetera, of the reality of mini grids. So I think there's an understanding from the DFI side. I think there's work also, the mini grid developers ourselves also have work to do, right? So that we can meet somewhere in the middle. We also have to work on the size of our portfolios. We have to work on our internal capacity, because when you're raising finance, you're raising majorly project finance for the project, but there's going to be an element for your own corporate development, right? And why would the DFI, the investor, give you that if you have not proven that your internal operations, meet certain standards, or that your unit's efficiency is not improving over time, that sort of thing. So we've got work to do, and we are trying to do that work as we light, in order to be able to do bigger ticket transactions and then meet them halfway somewhere, and get that appropriate local currency affordable financing that we're looking for.
So what would you be able to look at, let's say, project financing versus corporate financing in that case?
Yes, we can look at either, as FMO at least. But I think that it's all a bit of a chicken-egg discussion, right? Because we need scale. To get to scale, we also need large developers. But to get large developers, you need scale in the projects. So it's a very circular discussion. I think you have to start somewhere. I think my personal view is start really with having sizable, well-structured, grant-funded tenders or grant programs. And then my personal expectation is that the developers will follow, in a way. And then when the developers will follow, I think there will be financial products that will suit them, right? As an example, as FMO, we can provide construction finance and long-term debt funding. On that side, on the corporate front, we can provide smaller funding or smaller funding tickets. I know there's other financiers who can do sort of bridge funding to get to an RBF type payout. So there's different funders in the whole ecosystem. I think all the funders are there, and we're all just waiting for the scale of the programs to really get there. So I think let's start there, and then I think the corporate funding will be there very quickly when there's a clear pipeline of projects. And then we're happy to fund WeLight in any structure we can think of. Yeah.
Okay. I wanted to get, I know we are almost out of time, but I was hoping to get a few questions from the audience directed at any one of them before maybe we close out. Oh, wow. I think you answered everyone's questions. Yeah.
Check. Thank you. My name is Humphrey from CrossBoundary. I guess a question to the whole panel would be around the role of DFIs in attracting private capital. Attracting private capital. So DFIs can provide capital, be flexible, blend finance, but what about bringing in private capital?
Thanks, Humphrey. Well, that's what we're trying to do. We try to bring you in a couple of deals. So we're working on this very actively. No, I think the mandate that we have at ElectriFI in particular is really about leverage and additionality first. Where can we step in? How can we help some project to be unlocked, right? Financially speaking, but also personally speaking. So from that perspective, we've done a lot in the past, continue to do. Obviously, we moved a little bit with the market that is now growing, right? We were a bit more VC in the early days. We're a bit more structured today. But when it comes to leverage and attracting private capital, I think in our portfolio, I think today out of the 50 company we've invested in, I think if my memory is correct, we've been able to leverage over 400 million of capital in all those projects. So the way we work is definitely to try to bring capital. That also allows us to take very early stage position because of the network we have representing those European DFIs, so the FMOs, the North Fund, the Sweat Fund, the BO that is also maybe in the room. Well, the European bilateral DFIs, right? So we're also capable to try to bridge, our portfolio company towards, our big brothers, our big sister, big more structured in a way. So we have been able to achieve that. Obviously, I don't want to show off too much because that goes with many difficulties, right? and also because it goes with the need for the market to structure more and be capable to be more attractive also to DFIs. But we've discussed that already, right? Scale, also having developers that work on a going concern basis. And I think that's where I see also the vast majority of the capital going today is established developers that are capable to use their own equity base and capital base to pre-fund some of the work. And so the equity bits, for me, remains essential to the success of the sector.
Okay. So maybe just from each of you, and I can start with you, Ward. Oh, go ahead, please.
Sorry. I wanted to ask the FABO guy. You mentioned that one challenge for you is that projects, until they address the issue of scale, it's not attractive to FMO. So what is FABO doing to address that barrier? Because whether you like it or not, everyone in this space certainly will not belong to that market you're looking at. And so how do you bring others who want to get to the point where they can access the funds FMO has? And I think it also resonates with what somebody mentioned during the first plenary session this morning, and she said that there's fund. It's not the issue of funding. There's funds available. And we keep hearing people say there's no fund, and some persons are saying there are funds. So what is the issue? How do we address the issue of no funding? And if there are funds, how do we address, the demands or the requirements to make these funds flow?
Yeah, no, sure, I can answer that. So I think first of all, we try to be as creative as we can within the boundaries that are set for us, right, as a DFI. So as I mentioned, we try to make sure we can aggregate different portfolios from the same developer, maybe from different developers together, right, into one financing platform. And like that, try to get our funds to sort of, I guess, trickle down to every part of the ecosystem. We're doing that in solar home systems, for example, where we funded a few platforms who are then able to give, let's say, $500,000 or $1 million type of loans to different companies, just so we make sure we reach every part of the ecosystem. And now next to that, this is the only thing we can do from our own balance sheet, by the way. And next to that, we're working on developing what we call a market creation strategy. That's one of the key strategic priorities for FMO over the coming years, where we really try to go more downscale, right, and try to be able to provide smaller, slightly more concessional maybe type of funding to earlier stage developers, just like you're mentioning, to get them to the level where they are, let's say, reachable for the likes of FMO, but also for the likes of an ElectriFI, for example. It would also come with TA, for example, to make sure that their governance, etc., is also at the right level. But again, that's not the bread and butter of a DFI. The bread and butter of the DFI really is doing the larger scale infrastructure funding. And we're trying to be as creative as we can in the mini-grid space, just because we think it's very impactful.
Okay. So maybe just quick word, 2 seconds, literally, from Wale and from Quentin, just letting us know what is the main takeaway you want for everybody at the end of today.
Well, I think the main takeaway for me is we are glad to hear the progress the DFIs are making on local financing, but we need them to close that gap. We need to actually execute this. Mini-grid developers, the opportunity is there, but the financing must come at the right price, in the right currency, with the right terms, and it's a viable sector, and we've proven that, we and other mini-grid developers.
Yeah, just one word. I cannot agree more with that. I think, there is a need to have different layers of capital available for the mini-grid space. And I think equity is essential not only for developers, but also for other type of more commercially driven capital to step in. The grant for me needs to be definitely tailored to the typology of concessions, I think, when it comes to metro urban grids, maybe the grant is less relevant than a purely rural. We also have to understand that reaching the poorest of the poorest in very rural area is probably less relevant from a purely commercial perspective and needs to be tackled with ad hoc funding and facilities. So I think there is a need to continue the thinking around where am I in the market? Am I in the sweet spot? Am I doing a good job? Do I need to reinvent myself a little bit and it's not only the investors, I think it's everyone. Developers, funders, regulators, everyone needs to do his part of the job.
All right, thanks everyone. We've come to the end of our session and I hope this was insightful. I will offer their time if you have additional questions for them. But yeah, thank you. Thank you for your presence.
Yes. No, it made that chance. No break, though. Just continue with that one. So,
Hi guys, so